Look at the chart on your screen. On the right is the real economy, and it is dying. The cash freight index just hit 0.93. That is the lowest level since the great financial crisis, excluding the 2020 lockdowns. We have seen 3 straight years of declining shipments. Physical goods are not moving, demand is evaporating. Yet, look at the left, stocks are at record highs. Margin debt is exploding, silver is going parabolic. If the real economy is in a coma, what is fueling this asset explosion? And the answer is hidden in $145 billion number released this week by the Treasury and a critical signal flashing red in the London silver markets. So today we're dissecting the liquidity trap that is about to snap. Welcome back, I'm Georgie from Stacked Insights, and we track the flow of capital, not the flow of headlines. Let's cut the fluff. If freight is down, corporate earnings should be down, right? But they aren't. Why? Because the markets has stopped trading on economics and started trading on leverage. Look at this. US margin debt just surged to a record $1.23 trillion. That is 11.3 billion jump in December alone. This is the 8th consecutive month of increases. Growth in leverage is outpacing the S&P 500 gains by 20 percentage points. We haven't seen a gap this wide since 2021 meme stock mania. And if you exclude that anomaly, you have to go back to 2007. And it's not just the United States. China margin financing just hit record $390 billion. That is higher than their 2015 bubble peak. The world is leveraged to the hilt. Investors are borrowing money they don't have to buy stocks at valuation that make no sense, betting that the central banks will save them. And the scary part, they might be right about the banks, but wrong about the timing. So if you want to understand these mechanics before they hit your portfolio, do me a favor, hit the subscribe button and turn on notifications. We don't sell hype here, we analyze the data others ignore. Join the 1%. Here is the problem with the bull case. Look at this chart from Bank of America. Global fund manager cash levels have plunged to 3.2%. This is the lowest level in history. Let us sink in. 3.2%. Everyone is already in the pool. The bears have capitulated. The FOMO is maximized. From a contrarian perspective, this is terrifying. If everyone is bought in, who is left to buy? This is where the narrative shifts. Usually when cash is this low, we see a rotation. Money doesn't leave the system, it just moves rooms. And right now, smart money is walking at the door and running for the exit. The DXY, the dollar index, is starting to collapse. We're hearing reports that the Fed is actively coordinating with Japan to stabilize the yen. The Fed is buying $55 billion in treasuries in the coming weeks alone. And this is not QE, right? Well, it's QE, unfortunately, but it is also a liquidity. And liquidity kills the currency to save the bond market. But there is a deeper structural rot here. Look at this chart. USD assets as a share of foreign exchange reserves have dropped below 58%. While they are still at elevated levels, I think this is critical because the reserve currency privilege is what let the US export inflation and live beyond its means for decades. Because if you lose that status and inflation comes back home, and it comes very fast. And this structural decline is why central banks are dumping paper and buying real things. This brings us to silver. If the dollar is dying, metals fly, but you have to be very careful here. We are seeing extreme dislocation in the physical market. Let's talk about London lease rates. Normally lease rates are near 0%. Recently they spiked to 2.5%. This means banks were desperate to borrow physical silver to cover short-term obligations. It signals a massive shortage of physical metal in London. However, and here is the bear case you need to hear, those rates are starting to normalize. They are coming down from extreme readings, above 7%, and if lease rates drop back to zero, it means the immediate squeeze is over. Combine that with Shanghai premiums hitting record 12, and we have a parabolic move. Buying a parabolic chart when lease rates are normalizing is very dangerous. I am bullish on silver long term because of the debt problem, but in the short term, we could see a brutal washout if those premiums collapse. Why does the floor hold eventually? Because of the debt wall that the United States is facing. 1/4 of all US government debt matures in the next 12 months. We have to refinance trillions at 3.75% or higher, and the last time we hit this wall, rates were at zero. The United States government ran $145 billion deficit in December alone, plus 67% jump year over year. So they cannot afford positive real rates, right? They must debase the currency, and this is why the Fed is buying bonds. This is why the dollar is weakening, and this is why, despite the risks, funds are dumping cash for hard assets. So here is the playbook. We have a broken real economy, which is the Fright Index. We have maxed out leverage, which is the margin debt, and we have a central bank forced to print to save the Treasury market. The pain trade is not a crash yet, and it is continued melt up in assets priced in the value of dollars, followed by liquidity air pocket when that 3.2% cash buffer runs dry. I'm watching one indicator next week, the USD GPY pair. Just look at the report from Societe Generale. They have decided to bring forward their forecast for the next rate hike to April. They now expect the BOJ to raise its policy rate to 1.25% in October after a 6-month gap. This is the pin that pricks the bubble. If the yen strengthens on these rate hikes while the Fed expands its balance sheet, the dollar carry trade unwinds, and that margin debt we talked about, it gets caught. Watch the lease rates, watch the yen. Do not chase parabolas. Position for the debasement, but respect the leverage flush. If you found value in this deep dive, smash the like button. It helps the algorithm find other thinking investors. Also, please make sure you subscribe so in case you don't miss our next video. See you in the next one.